Let's go through an introduction of this video. So we're going to go through an overview of Forex and some basic concepts. And in this particular video, we're going to go over things that will tie into later slides, later videos, later modules, okay? So please keep in mind that while the start of this course and certain areas of this course have some very basic concepts, again, the intent is to build upon and expand upon those basic concepts into more advanced topics. So if you're watching this course and you already know some of what we're going to go over, hang tight, because other people watching these videos, they don't know what you know, okay? So we're going to walk everyone through the beginning, through some very basic stuff. And I can almost promise you, there's going to be stuff in here you didn't even know. I've had plenty of people go through this course to kind of test it out and everything and say, hey, wow, I'm kind of experienced with Forex. I've been in here a year and your basic stuff taught me stuff I didn't even know. So don't even think about skipping it. Just hang tight, go through the course as intended, and we'll start going on. So what is Forex? Foreign exchange, commonly known as Forex or FX, is the exchange of one currency for another at an agreed exchange price on the over-the-counter market. Forex is the world's most traded market with an average turnover in excess of 5.3 trillion per day. Now, to give you a perspective, okay, 5.3 trillion a day is more money than Bill Gates' net worth traded a day. Like, that's a lot every day. But the beauty about Forex is that anybody can do it. You don't have to be some hotshot Wall Street guy. You don't have to have $1 million in the bank. You don't even have to have 100 grand in a bank. So is Forex like stocks? This is a very common question we get. While the underlying trading principles are pretty similar, and there are some correlations, Forex is not like stock. The actual money traded in these markets are very different. The actual assets, what's actually happening in the market, pretty different, okay? Stocks are a multi-billion-dollar market that also moves very slowly. It's not a very fast-paced moving market overall. Forex is a multi-trillion-dollar market and moves very fast. So stocks themselves are shares of companies which you can buy and sell. When a stock price fluctuates or moves, it does so in points, and points are equivalent to dollars in stocks, okay? But when trading in the Forex markets, you're buying and selling foreign currencies, not shares of companies. When the price of a currency pair fluctuates up and down in Forex, it does so in pips, which are not the same as points. And we're going to go over pips next. So, before we go over pips, let's go over the reality of trading to set some expectations here, okay? The harsh reality of trading is that 90% of people who attempt it either never make money or lose their hard-earned money, or both. This course is designed to help you rise above statistics. 80% of people who attempt what you want to attempt fail. This course you're going through is designed to help you rise above the statistics, to rise with the challenge instead of being engulfed by it. Because believe me, I know how hard it is to rise above this challenge. I know how easy it is to get engulfed by it, to give up on it, to lose money with it, to be frustrated, to feel like everything out there in the trading niche is just garbage or someone's misleading. We get it, and this course is for you. To filter out all the other garbage that floats around the trading industry, we're giving you a course that is not only unique, but truly helpful on your journey. Truly helpful. This course has already been reviewed by many people already. Stellar reviews. So you can rest assured, this is for you. Now always remember that trading requires dedication, consistency, patience, time, and a lot of other things. If you're willing to do what it takes, trading will pay you. So, again, some expectations. If you're expecting to get rich quick, trading might not be for you. Trading is very lucrative and can make you a lot of money. It doesn't usually happen overnight for people, and that's what a lot of people want and or expect. Like we said it before, it takes time, dedication, consistency, and more. You have to learn to crawl before you can walk, and then maybe once you can walk, you can think about running, right? You're not going to be able to just run when you can't even crawl, which is the expectation most people have, or If you didn't have it, chances are maybe you were sold by others in regards to trading. This is not an expectation you should have. What you should have is that this course is going to help you, give you a foundation, teach you how to crawl, teach you how to walk, and in the end, we'll even try to teach you how to run. But everything is up to you. How much do you put into this? How much energy? How much studying? How much time? You're going to get out of trading, just like a lot of things in life. You're going to get out of trading what you put into it. So if you're willing to do what it takes, like we already said, trading will pay you. You will get paid. You will succeed if you can put in what it takes. But it's not for everyone. Now getting to it. Now that you've been given some expectations, or rather had some proper expectations set, along with a little information so far, let's actually start to dive in a little. What is a pip? A pip is a point in percentage, also known as a percentage in point, and or sometimes referred to as a price per interest point or price interest point. The most common thing you're going to hear it as is point in percentage or percentage in point. But the important thing to know is that it is a very small measurement of movement of a currency pair. In the Forex market, the markets move in pips. It can be measured in terms of the quote or in terms of the underlying currency. And we're going to go over quotes and currency pairs and everything like that in just a second, okay? But in all pairs not involving Japanese yen, the JPY, so more like USD pairs, so Euro USD, a pip is 4 places to the right of the decimal. So you'll have on Euro USD, say 1.05, and then a bunch of numbers. Decimal, 4 places over. When that number moves, that's a pip. And in all pairs involving the Japanese yen, so anything /JPY, a pip is 2 places to the right of the decimal. It's very important because a lot of people will teach you the first one, but they don't teach you the second one. They're both really important. Now, what is a currency pair? A currency pair is a quotation and pricing structure of the currencies traded in the Forex market. The value of a currency is a rate and is determined by its comparison to another currency. The first listed currency of a currency pair is called the base currency, and the second currency is called the quote currency. If you buy a pair and you are buying the base currency and selling the quote currency, this is known as going long. Selling is known as going short or shorting. Let's go over real quick over here. Okay, you see Euro, the base currency, USD, the quote currency, right? This is your bid price and your ask price. Okay, we're going to go over this in just a minute, but a very fundamental thing that I want you to know is if you buy Euro USD, if you buy USD JPY, if you buy a currency pair and the market goes up, you're in profit. If the market goes down and you bought, you're going to lose money. And then reverse that for a sell. Just keep this in mind. It's a very fundamental thing. If you buy and it goes up, that's good for you. If you buy and it goes down, that's bad for you. Sell, opposite of the buy, right? Okay, so let's go over a bid. A bid is a buy price that represents how much of the quote currency you need to get 1 unit of the base currency. We can see this outlined right here. And the ask is the sell price. It represents how much you will get in the quote currency for selling 1 unit of the base currency. So, we've told you about bid and ask, we've told you about currency pair, we've told you about buying and selling. Now, what does this really mean? To put it into a bit of perspective before we continue, you're going to have currency pairs. You're going to have currency pairs when you trade Forex, USD JPY, Euro USD, some major pairs. You're going to buy them or you're going to sell them. You're going to go long or you're going to go short, right? That's the important part to remember. That's how you trade. In stocks, you're going to have shares of companies that you buy and sell, right? You put your longs and you put your shorts and everything. In Forex, there are no shares of companies. It's currency pairs. So just remember that piece out of this. Bid and ask price is going to take a little time for you to fully grasp your head around. That's okay. Don't worry about it. Just know that instead of trading an asset like a share of Apple or Google or something, you're trading a currency pair. Now, what is a spread? The one thing you always need to pay attention to when trading any market is the spread. The spread is the difference between the buy, aka the bid price, and the sell, aka the ask price. Now, essentially, we care about the spread because it's the cost of trading between the currencies. It's the cost of actually making the trade. We pay the spread costs on every single trade that we take. Now, it is pretty standard by most Forex brokers to have variable spreads, which means spreads will fluctuate up and down all day long. Though, keep in the back of your mind that some brokers offer what we call fixed spreads. Now, that's not very common for most people to even worry about, so don't worry about fixed spreads. Just know that they exist. That way, if they ever come up, you have that knowledge. And fixed spreads, they're just, instead of the spreads fluctuating with the markets, just say a 10 or 15 pip spread fixed all the time. The problem with that is that the spreads could really be like 2 pips on a pair, but you're always going to be paying 15 pips. The advantage to that is if the spreads jump to 40 pips, you're only paying 15 pips. So most of the times, fixed spreads are used in algorithmic trading or trading that needs an expectation of a fixed spread built in. Most people don't need to concern themselves with this. So variable spreads are typically based off of liquidity in the markets and also pricing from the broker's liquidity providers, okay? We're going to go over this in later portions of the course. Now, typically, spreads will fluctuate higher during session changeovers, which we're going to go over, during times of high market activity, and sometimes during low volatility and other various times and conditions. You're typically going to reference what your spreads are from your trading platform, but you can also ask your broker. So if you are using your trading platform, the most common one is MetaTrader 4, MetaTrader 5, CTrader, Thinkorswim, and a few others, right? If you can't find it available or you're having trouble, just go ask your broker. Go find your broker's support email, their support chat, etc. Go ask them. Then you can figure out, and sometimes it's on their website. Sometimes a broker's spreads are going to be displayed on their website. Typically, and we're going to go over this in just a second, typically Euro USD, USD JPY, and major currency pairs have the lowest spreads, the cheapest cost to trade, right? So just remember that. Now, always remember that before your trade can be profitable, you must overcome the spread. That's one of the most important pieces in this slide, okay? You must overcome the spread before your trade is in profit. This is why you would generally hear traders favor brokers with low spreads, and why you hear traders bash brokers with high spreads, okay? Because, like we said in the last slide, the spread is the cost of doing the trade, of executing the trade, of being able to trade. Brokers need to build in the spreads from their liquidity providers. It's a part of the process. It's a part of the whole entire Forex experience, the broker's system. So if you have that bid price at 136.40 in this picture right here, or 136.42 for buy and 136.40 for a sell, okay? The difference between these two is a 2.1 pip spread, okay? Euro USD, 12019. Bid, ask, the spread, the difference between the buy and the sell price. The spread value is 1 pip. Now, if this slide is confusing you, just remember that when you buy, okay, if you buy Euro USD, you can buy at, say, 136.42, okay? And if you buy at 136.42, you've got to overcome the spread before you're in profit, okay? So if you say, I'm buying at 136.42, and I think the price is going to rise to 137.50. Before you will be in profit, you have to overcome 2.1 pips that are deducted, if you could even say that, deducted from your profits, okay? Just keep that in mind, and then you will be in profit. That's the most important thing I want you to take away from this slide is you have to always account for the spreads. A lot of traders who get into the shorter time frame trading forget about spreads, and so their trade would have been profit except for the spread was a few different pips. They didn't account for that, and so they were negative just by the spread. Now, we mentioned this briefly a few minutes ago. Major, minor, exotic pairs. I mentioned major pairs to be exact, right? USD, JPY, Euro USD, etc. Okay? So in regard to currency pairs, there are 3 types that the pairs get classified under. Typically, the pairs that have the most traded volume against the USD are considered the major pairs. So for example, the current major pairs are Euro USD, USD JPY, GBP USD, USD CHF. These are the most liquid pairs with the most movement, and typically the spreads are smaller on these pairs, which is favorable to traders. These can also be a little bit more predictable pairs as well. Now, currencies that are not associated with USD and considered minor pairs, aka crosses or cross pairs, minor pairs can still have plenty of volume and be equally or more profitable than major pairs. They can also move just as much or more than a major pairs. GBP JPY is a great example of this, though not recommended for newbies. GBP JPY is referred to as the dragon. It is a volatile, which we're going to go over volatility. It is a very volatile, crazy moving pair that commonly takes people's money who are too new, and even some experienced guys, okay? It is a wild pair. It's like gold, which gold is a commodity. So another thing you have, aside from major, minor, exotic pairs, is commodities. They are typically like metals and assets. Commodities are not currency pairs, and they're going to be gold, silver, other metals, etc. Now, GBP, JPY, crazy, gold is crazy. They're extremely volatile and often move in ways that novice traders will not be prepared for. And typically the spreads are more medium on these pairs. They're a little higher than the major pairs. So not only are they crazy, but at the same time, the spreads are a little higher. So if you're not more precise with your trading, you could lose more money, okay? A lot of people who are new don't necessarily get told this or don't ever find this information, and so they end up trading just any pair they could possibly find and don't realize the spreads come into play and the volatility comes into play, and there's so many different aspects, right? Because when you're new, you don't know. All you know is you pop open MetaTrader 4 if you even got that far to installing it, right? And you pop in a trade to whatever currency pair might look good to your eyeball, and you go for it. Well, now you have a little bit of structured information to help you know that while you're new, you should probably stick to major pairs. And the last one I want to go over is exotic pairs are the pairs that include the currencies of emerging markets. These pairs are not very liquid, and typically the spreads are much wider on these pairs, bigger spread. A good example is USD Mexican or USD Turk. Basically, these are the third world country pairs, or maybe not third world countries, but they're not widely traded pairs. They're exotic because they're the countries that you really wouldn't expect to have the currency pairs, or to be able to trade, right? Or maybe you would expect to trade them, but like I said, they're just not very liquid. They're not heavily traded. Therefore, the cost of trading them is much higher. So far, over the information we've gone over, why are the pairs and pips important? Well, you buy and sell the pairs, okay? The pairs move in pips, and when you buy or sell, if the pair moves in the direction you said, you make money. Pro tip so far. Now, here's a basic charting example. So you have your currency pair, Euro USD. You have your time frame, which we're going to go over. We'll go over those. Candlesticks, we'll go over these. And price levels, briefly kind of touched on this already. Okay, this is what a chart looks like. Different platforms have different variations of this, but this is what it generally looks like, give or take. So, some other things we're going to cover before we go ahead and end this video is trading sessions. The Forex markets operate 24/5. The markets close every week on Friday at 5 p.m. EST. They open every week on Sunday at 5 p.m. EST. Now, those times kind of change with your broker. Different brokers kind of do weird things. Just know that in general, this is the operation times, okay? It's very different than stocks. That's why I said the underlying principles of trading are pretty similar between Forex and stocks, but actually trading them, what you're trading, times, etc., very different, okay? The stock market does not operate like this. So, the most liquid sessions are London and New York session, and sometimes Asia. Session is going to be right here in Eastern Standard Time. This is New York session, okay? Also note that spreads usually widen during the session crossovers. So this is a crossover time right here. This is a crossover time. This is a crossover time. This is a crossover time, okay? Any time a session crosses over with another session, spreads can widen. Don't always have to, but they can. And sometimes they widen before bigger market movements, so keep that in mind. Now, I did mention we were going to go over time frames before we end the video. Typical trading time frames are the 1 minute, the 5-minute, the 15-minute, the 30-minute, the 45-minute, the 1 hour, the 4 hour, the daily, the weekly, the monthly, okay? These time frames are independent of the trading sessions. Sessions are the overall daily market sessions by the exchanges that open up during different times of the day that you can trade during the different times of the day. However, time frames are on your platform to show you different time frames of the market, not just a separate chart to trade on though. Think of a smaller time frame as zooming in to the markets and the higher time frames as zooming out of the markets. With the daily being pretty much the base, some people use the 4 hour as a base. That's fine. Depends on if you're trading super long term or more just long term in general, but 4 hour to daily, depending on the trader you ask, is going to be the base. All of the time frames correlate with each other though. From the minute to the monthly chart, it's all one big market. You can slice it up and view it in different time frames. This picture right here shows you a good example. The 15-minute candle, which we'll go over candles soon, a 15-minute candle represents 3 5-minute candles, okay? And each one of these 5-minute candles represents 5 1-minute candles. And when you're viewing the time frames, like I said, you're zooming in and you're zooming out. So you're going to view a 15-minute time frame, and when you go to the 5-minute, you're actually viewing this small piece of the 15-minute. And then when you zoom into the 1-minute, you're viewing a small piece of the 5-minute. And if we were to go from the 15-minute to the hourly, the 15-minute would be showing us the small piece of the overall hourly picture. This is a really important concept called multiple time frame analysis. The time frames correlate with each other. They are not separate. They are not independent of each other. Most new traders totally miss this, which is understandable, but it's a very, very important concept to accelerating your profitability and ability to even just trade effectively. Time frame analysis can really, really matter, okay? So just remember that when you are zooming in on a lower time frame, you are zooming in on the market, and when you are going to a higher time frame, you are zooming out. It's all one big picture. You're just viewing the picture in different slices, okay, in different viewpoints. Just remember that, okay? And based on what style you like to trade, you will be viewing different time frames. So if we'll go over different styles and everything in a video soon, but you will be trading the currency pairs that move in pips, like we said before, on different charting time frames. Lower time frames are going to be for shorter trades, and higher time frames are typically going to help you with longer trades. But we'll teach you at the very end a chart markup, chart analysis module, okay, from top down. So just hang tight. Let's go through the information, take your notes, and we'll tie everything in together as we go. Now, the last thing before we finish this video is, who are you trading against? Okay, who are your competition, your co-traders, etc.? Companies and businesses, they can be institutions, but might just be trading businesses. They make up a really good portion of the market. Investors and institutions often make up hedge funds, firms, liquidity providers, all sorts of traders. This is a good portion of the market as well. And then you have banks. They have big pockets and are often responsible for providing the rates we trade. They're a smaller portion of the market, but still a decent portion. And they're one of the more powerful portions of the market, okay? And you have central banks, which are policy dictators with large reaches and deep pockets, smaller portion of the markets. And then you have retail traders. Some say it's a small portion of the market. Other people say it's a lot of portion of the market. Retail traders are just the common trader that can get on through the Forex market, through a retail trading broker, and just trade. They're typically common people, okay? And then you have algorithm, computers, and quants. They make up a huge portion of the market today as computers get more prevalent, algorithms get more prevalent, etc. Make up a huge portion of the markets and liquidity and movements and everything. So, with this being said, this concludes this video. Just remember, the Forex market is huge. It's lucrative. It's maybe even a little crazy, but it's also crazy awesome. So, thank you for watching this video, and let's keep going on in the course and learn more.